Welcome. Today we're diving into the intriguing world of rental losses and how they can be used to offset W-2. Imagine you're the owner of a rental property, a savvy entrepreneur with a keen eye for real estate. Your property serves as a source of income, collected from your tenants in the form of rent. But what happens when the cost of maintaining this property exceeds the income it generates? You, my friend, have just encountered a rental loss. Rental losses occur when the expenses related to your rental property, things like mortgage interest, property tax, insurance, depreciation, and maintenance, exceed your rental income. It's a situation that can seem daunting at first, especially when you're left with a negative figure on your balance sheet. But here's the beauty of it. These rental losses can actually work in your favor when it comes to offsetting your W-2, potentially reducing your taxable income. Understanding rental losses is the first step in the journey to offsetting your W-2. Now that we have a grasp on rental losses, let's delve into what a W-2 is. A W-2, also known as a wage and tax statement, is a form that an employer provides to their employees and the Internal Revenue Service, IRS, at the end of each year. It breaks down your annual wages and the amount of taxes withheld from your paycheck. Why is it important, especially for entrepreneurs? Well, it's a crucial part of the tax filing process. A W-2 provides the information necessary to accurately calculate and report your income taxes. It allows you to see how much you've earned and how much has already been paid to the government on your behalf. As an entrepreneur, it can also provide insights into your employees' earnings and the payroll taxes associated with them. With a clear understanding of W-2, we can now explore how rental losses interact with it. Rental losses and W-2 might seem like unrelated elements, but they share a significant connection when it comes to taxes. In the realm of taxation, rental losses can serve as a handy tool to offset the income reported on your W-2 form. But how does this work? Well, it's all tied to a concept known as passive activity losses. Now, what exactly are passive activity losses? In simple terms, they are losses incurred from rental real estate or business in which you do not materially participate. And yes, your rental property falls under this category. If your expenses for maintaining the rental property exceed the income it generates, you have a rental loss. What makes passive activity losses particularly interesting is how they interact with your W-2 income. You see, typically, the IRS allows you to use passive activity losses to offset only passive income. But there's an exception to this rule. If you or your spouse actively participate in the rental activity, you can deduct up to $25,000 of your rental loss against your W-2 income. Active participation in this context means making managerial decisions or arranging for others to provide services. This could include things like approving tenants, deciding rental terms, or arranging for repairs. But hold on, there's a catch. The $25,000 deduction begins to phase out if your modified adjusted gross income exceeds $100,000 and disappears entirely once it hits $150,000. So, while rental losses can indeed help offset W-2 income, it's essential to understand the nuances and rules associated with passive activity losses. By strategically managing your rental properties and understanding the tax implications, you can potentially reduce your taxable income, which in turn could lower the amount of tax you owe. This intersection of rental losses and W-2 forms the basis for a strategic approach to managing your taxes. Remember, every bit of savings counts, and understanding these intersections can make a significant difference in your financial well-being. With the basics covered, we can now delve into the step-by-step process of using rental losses to offset W-2. First, let's understand what rental activity is. Any property you rent out, be it residential or commercial, is considered rental activity. This includes vacation rentals, apartment buildings, office spaces, and even single-family homes. The income you earn from these properties is rental income. Next, calculating rental losses is essential. This is done by tallying up your total rental expenses and subtracting them from your total rental income. If your expenses exceed your income, you've incurred a rental loss. These expenses can range from mortgage interest and property taxes to repair costs and depreciation. Now, if you do have rental losses, the Internal Revenue Service, or the IRS, allows you to offset up to $25,000 of these losses against your other income. This is known as the $25,000 rental loss allowance. But keep in mind, this allowance is subject to phase-out rules. If your modified adjusted gross income, or MAGI, is more than $100,000, the allowance begins to phase out. By the time your Magi reaches $150,000, the allowance is completely phased out. So if you're fortunate enough to have a Magi less than $100,000, you can take full advantage of the $25,000 rental loss allowance. But if your Magi is more than that, you'll have to calculate the phase out. Here's a simple way to do it. Subtract $100,000 from your Magi. Now take that number and divide it by 2. The result is the amount by which your $25,000 rental loss allowance is reduced. Let's take an example. If your Magi is $120,000, then the amount by which your allowance is reduced is $10,000, which is half of $20,000. So your new rental loss allowance is $15,000, which is $25,000 minus $10,000. Finally, reporting this on your tax forms is the last step. If you're a sole proprietor, you'll report your rental income and expenses on Schedule E of Form 1040. The IRS requires you to provide detailed information about your rental properties, including their location, type, and rental days. Your rental income, expenses, and losses are then listed on the respective lines. If you're able to offset your rental losses against your W-2, the amount of your taxable income on your W-2 will be reduced. This could potentially move you into a lower tax bracket, saving you a substantial amount of money on your taxes. However, it's important to remember that tax laws are complex and subject to change. It's always a good idea to consult with a tax professional or a certified public accountant to ensure you're taking full advantage of the tax benefits available to you and to avoid any potential pitfalls. So there you have it. By determining your rental activity, calculating your rental losses, understanding the $25,000 rental loss allowance, and knowing how to report this on your tax forms, you can navigate the process of using your rental losses to offset your W-2 income. By following these steps, you can effectively use your rental losses to offset your W-2. Let's take a moment to recap the key points we've covered today. We began our journey by understanding rental losses. These are losses incurred from renting out a property, and they can occur for various reasons like maintenance costs, property depreciation, or even periods of vacancy. It's important to remember that rental losses are not always a negative. They can be leveraged as a tool in your tax planning strategy. Next, we delved into the world of W-2, the wage and tax statement. This form is used by employers to report your annual earnings and the amount of taxes withheld from your paycheck. It's a critical document that plays a pivotal role in your income tax return. Having established the foundations of both rental losses and W-2, we then explored their intersection. This is where the magic happens. The Internal Revenue Service allows you to offset your taxable income, as reported on your W-2, with any rental losses you may have incurred. In essence, this means that rental losses can reduce your overall tax liability, potentially saving you a significant amount of money come tax time. We then walked you through the step-by-step process of using rental losses to offset your W-2. This process involves correctly documenting your rental income and expenses, calculating your rental losses, and then accurately reporting these losses on your tax return. It's a meticulous process, but with careful attention to detail, it can be a game-changer in your financial strategy. In conclusion, we've navigated through the labyrinth of rental losses and W-2. We've understood their individual roles, their intersection, and the process of using one to benefit the other. It's a complex terrain, but with the knowledge you've gained today, you're well-equipped to traverse it. With this knowledge, you're well-equipped to navigate the world of rental losses and W-2. Remember, when used wisely, rental losses can be a powerful tool in your tax strategy.